I'd kick off because just like our previous session, everyone has really jumped on board and been very prompt to be part of the meeting today. So I'll just quickly introduce myself for those that haven't attended a Broker Illuminati session. My name's Chris Slack. Broker Illuminati was a little bit tongue-in-cheek. It was a series of professional development sessions that we'd started last year simply to see, to focus on some of the areas that brokers weren't getting any education on, in particular commercial lending. Now, this is really evolved and grown to being something a little bit more than what it was last year. Last year it was a networking, a few sessions and drinks, and this year we've got 10 Zoom meetings, content, bonus videos, MFAA, NFBAA, CPD points. We've really taken it to the next level. And the follow on from our morning session, we had a session this morning around structuring for businesses and what we can do as brokers and accountants for those people that have struggled with their business post-COVID. And this session we have right now is specifically around the treatment of tax debt and understanding the roles and how businesses are looking at their tax debt since COVID. And joining me today, we have Michael Moon from Tax Assure in Sydney. We have Olga Koskie from Tax Assure in Melbourne. And we have Brian Willett joining us, who has multiple practices around southern Sydney and Sutherland and Illawarra, as well as a practice up at the Sunshine Coast. I want to thank everyone for being part of our session today. While I've got you front and centre, Michael, can you give us a bit of an understanding about the current situation for Australian businesses in terms of how the ATO is looking at things, the actual scale and size of debt that's out there, and how you're seeing things in terms of businesses deferring payments, etc.?
Yeah, of course, mate. And look, thank you for the introduction and everybody for coming today. Look, it's going to be no surprise to anybody that the ATO debt has ballooned in the last financial year. And interestingly, the ATO put out their annual return last month, and it was, I guess, just to give you an idea of the scale of the numbers. And we track this every year, and it generally moves up around sort of 6 to 8% every year. But in the last financial year, and also noting that actually is only to June this year, it went up a whopping 30%. And to give you some numbers around it, there's a few people around here who probably like numbers around that. The current, what we call collectible tax debt, and that's the debt that's it's uncontested, it's not subject to any dispute, it's not subject to any insolvency event, has moved up to $34.1 billion. Now, to put that into context, in the 2018 financial year, it was 23.8 billion. 2019 financial year, it moved up to 26.6 billion. So that was a movement of about 2.8 billion. But then we've had a threefold increase for the 2020 financial year of $7.5 billion. So we all know why that is. The big factor around that is obviously COVID, and COVID's had a significant impact in terms of deferrals. The other thing to note around that is that 60% of that debt is owed by small business. And I think, a lot of people think that it's always the big end of town, but certainly the small business part of it certainly makes up the lion's share of that. So what does that mean? Well, I think probably the other thing to factor in is that we don't know what it's going to be by the end of this. We were talking before about there's a vaccine that's maybe coming in overnight. So things are starting to get back to normal a little bit better. Melbourne's a little bit behind because they've had their own issues, but it means that where this debt will end up if we roll forward to the current finance is anybody's guess, but it's going to be significant. Where that leaves businesses and is that we've had a lot of government support to date, but a lot of that government support is winding down. A lot of the banks have been giving assistance, but that's winding down. So we've really got this perfect storm of debt. And I guess probably the things that businesses need to do is to start planning now how they're going to get out the other side of that. There's new insolvency laws coming in. But those businesses that don't want to avail themselves of that and want to trade through this really need to have a plan. And obviously, from our perspective, it's a plan around their ATO debt, how they're going to not only get back on track and meet their ongoing payments and stop deferring debt, but to deal with historical debt. And I guess that brings us today with, you know, the group that we've got today as advisors to business, and it's on all of us to try and assist businesses to get through this, you know, very, very difficult time. For the funders and brokers that are on the seminar, again, it won't be, you know, everybody knows that there's a couple of ways that you can deal with historical ATO debt. You can either pay it out of cash flow, or you can get some funding or some capital in to help bring that debt down to a manageable level. We deal with clients in both cases, and often that we can have a hybrid arrangement around all of that. But I think more and more we're going to see that latter group, which is businesses that, you know, they're already cash strapped, they're already trying to get back to where they were before COVID, and get back to where they can actually meet their ongoing payments. So to then be able to deal with historical debt is going to be very difficult out of cash flow. So I think there's a real opportunity for funders and brokers to you know, really make a difference in terms of assisting businesses out the other side of this.
And look, couldn't agree more. And obviously we're coming off a session that's talked about those changes in requirements and insolvency. Brian, I'm going to throw to yourself. Obviously, you're one of the partners at FinCare, and you've got another business that solely focuses on cash flow for small businesses called Cashflow Consultants. How have you seen things on a micro level for the clients that you've had to deal with? And I suppose maybe just because we've got you there, I wouldn't mind for the other people that are on this call, for them to get a bit of a sense from you in terms of, there was a comment, there's been some comments about accountants being able to do this, that, and the other thing. Maybe it's important for you to give everyone a bit of a sense of what sort of additional workload was put on accountants since COVID, and just to give someone a sense of the quantum, if you would.
Yeah, no problem at all. The biggest thing for all clients was to work out whether they are eligible for any assistance. And for so many clients, that wasn't just a matter of saying, well, you know, initially you had to answer the question, are you down, going to be down more than 30% in your business? Which you can do a quick analysis or a quick estimate from a lot of businesses. However, the detail came in when businesses had changed. There was a hell of a lot of businesses that had been in big growth phases or had taken over something else. So to analyse every business as to whether they're eligible for assistance was step number one.
And we're talking thousands of businesses here, yeah?
Oh, yeah, yeah. And then you had, the government had a 3-step registration process before anyone could actually get JobKeeper. Separate to that, every month then was the reporting saying, well, what did you do, etc. last month? What are you going to do next month? And the reality was they'd already accepted you into the program. Filling that form in every month was irrelevant. So you ended up filling out multiple pieces of paper 6 times for every person who was in the program. And of course, every client who then has to fill it in every month is then concerned going, oh, am I now out of the program? No, you're always in it. You just had to fill in the form. So that was a form separate of the BASs. So, you know, even whether you're getting a monthly BAS, you still had to fill in a separate form. So it was really administration for administration's sake. Then there was the people that they decided not to pay JobKeeper for, and you had to go through a multiple level process to say, well, yes, they are entitled. And the other benefit that was being paid out was cash flow, the cash flow bonus, and you know that was supposed to be automated. 10 to 15% of the time, the ATO decided they weren't going to pay the cash flow bonus to certain people. In some cases, there was 6, 7 submissions back and forwards to the ATO for them to finally say, yes, you can get that cash flow bonus. So things that were supposed to be automated just weren't. Things were just replicated time and time again. And then the system come in place, the new at the end of September for October. Again, everyone who was on JobKeeper then has to reanalyse whether they were eligible for it moving forward. And then again, they're going to have to do the same in January. So we estimated that it's probably about 6 weeks of additional work per accountant in our office. And a lot of, we thought were fairly automated about the way we went about it and got a lot of our admin staff involved, etc. So for a smaller practitioner than us, they really would have been struggling.
Yeah, wow. So if I sort of flip that into tax debt, is it fair to say that there wouldn't have been a lot of conversation around that just for the average accountant, simply because of the sheer day-to-day of the government assistance in the short term?
Well, that's right. The cash flow certainly helped people. And as, I don't know whether people are aware, but these days that via the portal, an accountant can register that for a 2-year payment plan for tax debt, which is pretty much automated and accepted. So the amount of people needing help, yes, there was some. There was also a general, pretty much whatever you said to the ATO, they were willing to accept it during the middle of the COVID session. So yeah, it wasn't a lot of negotiation going on really. Whatever you said to the ATO, they just accepted for the moment.
So obviously that's obviously from the experience that you've had specific to your client base.
Yep.
How would you, Michael, classify from what you've seen? And obviously your focus is strictly on that tax debt negotiation. What would you say was your how you thought the ATO's attitude was in that period yourself, from your experience?
Yeah, sure, Chris. Look, I'd agree with Brian. In those sort of early days, mid-year, I think, the government were more concerned about the economy crashing and having thousands of deaths and so on and so forth. So there was certainly an ability to go to the ATO and as Brian said, put a case to them, and they generally accept that. And that I guess is where we've landed with a lot of the expansion of the tax debt, because there were a lot of deferrals and that was quite easy to do. And it was important to be able to do that because businesses didn't know whether they were going to be able to pay wages next week. So I think the government took a policy decision to say, well, look, don't worry about your tax now. Just worry about keeping your people employed. I think and I think it's fair to say that, to date, the ATO and the federal government have been very supportive of businesses around, or the cash boosters we talked about, JobKeeper, which is also being talked about, the deferral of the tax payments, and they've also been put in place a thing where if you register with the ATO that you are affected by COVID, that they were auto-remitting a lot of the interest along the way. What we're seeing now, though, and a number of you have probably seen the announcements that have come through from the commissioner and various assistant commissioners, that as of September, we're looking to get back to what they call shifting the dial back to more traditional activities, and that's around a whole range of things.
Sorry to interrupt, Michael. I'm asking genuinely, are we talking about the September that just passed or the September coming?
No, September's just passed. The ATO.
Okay.
So there was a distinct shift in the ATO's position on ATO debt in September. And they did announce it in July that it was coming, and at one stage they were talking about maybe it would start to be phased in July, but certainly in September of 2020. What they have done is, because the commissioners, I just mentioned, they issued the annual report, and those numbers are staggering that are in there in terms of the level of debt, and and they all know that it's maybe not the tip of the iceberg, but it's probably only part of the iceberg, because there's a whole bunch of stuff that's not in there. And so the commission is becoming under pressure from government to both rein in the increasing debt but also to then start collecting the outstanding debt. So in September, the ATO did two things. And we talk to the ATO every day, and we were across, from clients, but also we spend a lot of time with them in terms of understanding what their policy changes are. And they did a couple of things. Firstly, they've recommenced collection activity, and they now want taxpayers and they want businesses to start paying their tax. All the blanket holds and the blanket leniency, if I can put it that way, that they gave previously, they've stopped. And now, if businesses, and they want businesses, and it'll start with they're now just contacting businesses and saying, hey, look, you've got a couple of $100,000 in ATO debt. How are you going to pay it off? And so they now want businesses to start coming to them with a plan of how they're going to, firstly, meet their ongoing obligations and stop deferring debt, and secondly, how they're going to clear their historical debt. And if they, what we're seeing too is that it's no longer just, shout COVID and you're okay. They now want actual evidence from you that, yes, the business is affected by COVID, and how does the business sit in terms of that plan? Is the business still viable, and can the business trade through this, and how is the business planning to do that? The other thing they did in September, which I haven't seen announced, but we've certainly been told by a number of our contacts, is that they've started charging interest again. And, if you put that into context, the interest at the moment is 7.1% compounding daily for the people that love numbers in the room. But, you've only got to go back to September 2019 and it was 8.5%. So that will build up very quickly. So it means that, businesses start to need to deal with this. The other thing too, and again, it was in a lot of the stuff that was in the media throughout, but I'm surprised a lot of people still haven't come across this, that superannuation was never excluded from any of the measures that the government put in and the ATO put in place to help businesses through COVID. So the ATO has throughout the whole time expected businesses to pay their super obligations. If they haven't, to report them to the ATO and to start clear them through the ATO. So, and if we go back to prior to COVID, for about the 12 to 18 months before then, that was the number one thing the ATO were focusing on getting cleared by taxpayers. If we had a client that came in and they had PAYG debt, they may have income tax debt, they were here, but if they had super debt, then the ATO went a lot harder, and they said, well, what are you going to do about that? That hasn't changed. And so I think businesses need to understand that. Anecdotally, what we're seeing from the ATO on a daily basis is we have clients, I guess, that fall broadly into two categories. Those that prior to COVID had no debt, had never really had debt with the ATO, never had a payment plan, and had just gone along and been a compliant taxpayer. The ATO are a little kinder, if I can put it that way, towards those taxpayers, but they still want a plan. They want a plan now to clear the debt. Then you've got the clients that we saw more of pre-COVID, which were those that had debt and maybe had a bit of form with the ATO. Their risk rating, I'm sure some of you know, but every taxpayer who has debt with the ATO has a risk rating with the ATO. And depending on that risk rating, it depends what the ATO will do for you. If we're seeing already with clients that have a higher risk rating, that it's not quite business as usual, but we're not far off.
I'm going to pull you up there for a second. So every client has a risk rating with the ATO?
100%, yeah. And it's somewhere from 0 to 9. And depending on and there's a whole range of factors that go, it's not unlike a Veda rating or one of your credit ratings. And so a whole range of factors go in terms of your, your compliance to date, if you've had debt, if you've paid it off, if you've had payment plans that you've defaulted, a whole bunch of things that go in it. And the risk rating goes up and down depending on your activities. So what that means is, from an ATO perspective, is that when somebody rings the ATO and says, hi, I'm ringing for so-and-so client, I'd like to put a payment plan in place. The first thing the case officer does is a review of their matter, and they generally put you on hold and say, look, we're going to do a review of the matter. And one of the things they look at is the risk rating. That risk rating, to a great extent, determines what the case officer can and cannot offer to the taxpayer. So it's really important. And one of the things around this is that what we're certainly saying to our clients is, you need to engage now, you need to get it right, because if you just don't do anything now, even though the ATO is being a little bit more benevolent, if I can put it that way, and I think that's changed and will continue to change, risk ratings are getting affected. And then if it gets to a point where the ATO, and we're very close to where the ATO is going to restart legal recovery action, which is garnishee notices, wind-ups, all of that sort of thing, which they've put on hold but we're 5 minutes away from those restarting. They're starting the collection activity, and then that will be the thing they will do next. If you've let your risk rating get out of control, then when you talk to that case officer, what they can and cannot do for you will be vastly different. So certainly all of our clients, we're saying, get in contact with the ATO now, and get something in place with them.
Olga, I've got to throw it to you. For those that didn't hear us at the start of the call, Olga represents Tax Assure in Victoria and in Melbourne, and I would imagine that the climate towards Victorian businesses would be slightly different.
It was, but exactly as Michael said, we've seen now as of September, you can't just throw your hands in the air and say COVID anymore. They actually want to see how, why, and full applications put in as to why you're affected. And they've both put in the media and the press. There's been specific ATO press releases that as of September, collection action is happening again. They will take factors into consideration. So with the right submissions, with the right applications, we can get those plans and potentially more lenient plans, but they want to see what the factors are and won't just give blanket holds anymore.
It's interesting because I think that for a lot of people on this call, brokers may have seen one or two clients and potentially they haven't got what they needed to get from a lender, because just like you talk about putting your hand up and saying COVID, there's many lenders that have put their hand up and said, tax debt. So from my point of view, obviously, I see a lot of that, and I'll provide some overlay at the end of the session in terms of, I think, how lenders will look at different aspects of tax debt. But one of the things I'm always careful of, Olga, is that I find a lot of clients and some less scrupulous accountants, they'll look at the ATO as a very cheap form of borrowing. But having said that, I mean, hey, if you're in trouble and you've got tax debt and you've got someone who's willing to provide the right sort of term, hey, it's a commercial decision that you've got to look at it as a business owner. Cash is king, and if it wasn't king, it certainly is now. So from my perspective, what I'd like to know from you is, okay, what's the longest term the ATO are giving out on a loan, on a negotiation these days?
So I wouldn't actually call it a loan because the ATO don't like looking at it as a loan. And I also wouldn't call it a negotiation. So all of our background, all our directors are lawyers, where I was a commercial litigator. The ATO is a very different beast, so to speak. So you don't necessarily negotiate with the ATO. You need to they either put to you what they want, or when we look after clients, we put to them what a client can afford. And we do that by having a look at what the legal practice notes and requirements are. So the ATO have specific legal practice requirements, which they have to take into consideration if you want to call it a negotiation, in those situations when they're looking at applications. So in a roundabout way to answer your question, it comes down to a whole heap of different factors. One of the biggest ones is what Michael was talking about, which is this risk rating. Now, this risk rating can include the level of their debt, how many defaulted plans they've got, whether it's super, whether it's PAYG.
Is there transparency over this, Olga? Like, can I ring up the ATO and find out my risk rating? I'm Chris from the finance consultancy. We didn't have the year we would have liked, and I wouldn't mind that money in my account. Can I just leave it with you? No.
Yeah, I don't reckon it quite work that way. So
I'm just trying to provide some transparency over here, because I look at this and like, oh, hang on, there's a risk rating behind this, and a lot of people, if you look at the way a lot of consumers completely guard and treasure their Equifax rating. I had someone boast about their credit rating the other day. I thought, what the hell's that for? So I suppose that's what I'm more curious. Does Brian, as someone's accountant, how does someone find that out?
So sometimes they'll tell you, and sometimes it's part of the review process. We also deal with a different area. So accountants and Brian will deal with a compliance area usually, because that's their gig, that's their thing. It's all about compliance. We deal with a completely separate area. We deal with the debt area. We deal with the debt guys. We deal with directors in the debt area. So the questions we're asking and the reviews we do are solely around the debt piece, and that's usually where we find that information out.
Okay. Sorry, I was just going to throw back to Brian briefly. Brian, in terms of tax debt from a compliance point of view, obviously there's an element there that we talked about, and you provided some fairly revealing insight to the life of an accounting firm over the last 6 to 9 months, which I think for a few people here, the sheer quantum of work there's quite substantial. What I'm sort of curious about, and what I sort of want to get from you all, is what's, in your opinion, and I'll obviously provide mine as well, but what do you see as an appropriate level of tax debt? Is there a number, like in financier terms? I know there's a magic number that people look at in terms of percentage of their turnover, but I'm curious to hear all of your thoughts on the panel on that. Brian, can I get you to kick me off there?
Yeah, absolutely. I don't actually look at it from a point of view of a tax debt. I look at it from the point of view of the business in general, and looking from the cash flow point of view and what they can pay. And if I can't see a way that they can pay, irrespective of what the percentage is, we've got to look to some other levels. Funding obviously is one, but as you know, Chris, by the time they're at that stage, it's handball to the financier who says, look elsewhere. So, we had a position, you mentioned before about the longest term. The longest we've negotiated was 4 years. That was pre-COVID, about January. The business was never going to be able to afford it. However, we knew in a year or two that they would be able to sell a significant portion of that business off. So we're looking at it from a point of view, is the business viable? Is there a way for them to get out of the hole? And if there's not a way to get out of the hole, irrespective of the tax debt or other debts, it's all in the one piece.
Actually, a really important lesson there to call out for other brokers and people on this call. A lot of people tend to get caught up on servicing when you're evaluating the appropriateness of a commercial facility for a client. You've also got to remember that, just as you said there, Brian, the way out, regardless, is becoming, it's always been, if you're putting together a thorough commercial application, that's always been of importance, but there's a lot of people that haven't quite necessarily caught that, and I think that's a really good point you make. Michael, I'll throw back to yourself before I hear from Olga again. How have you seen things in terms of this space? How have you how do you see this?
Look, I think we're going to have, it's interesting times still. It's, again, if you look at where we were in February and March and where we are now, things have moved significantly. I think in both directions, in the sense that I think the well, certainly if I exclude the rest of the world and look at Australia, that we are in a much better place than much of the rest of the world. So we are at a space now where I think we're going to see business activity improve and come back on board. And with that will be further activity from the ATO, as we've said. And I think, if there's no other message, it is that don't wait. Now's the time to get, and I imagine that Olga and Brian would agree with this, that now is the time to start to work out how you're going to get through the other side of this and start working towards that. And I think came up on LinkedIn, the one that everybody's heard of, failure to plan is you're planning to fail. And I think there's very much the case at the moment that businesses need to, they've been able to sort of just defer and not worry too much about the ATO. And we've, and there's been a number of businesses that probably could have met their obligations and have done that, and just use it as a bit of a free kick to build cash flow, and so forth. But yeah, I think it's just time. All I can say is it's time to get engaged, and I'm sure Brian will be doing that with his clients. They just need to. The ATO now want to hear from people about what's the plan.
Yeah, and just on the back end of that, absolutely. And it's always been that way, but even more so now. And I had a new client that came on board not long ago, and the ATO just totally refused to do anything for them. And as soon as we contacted them and just started a different discussion, the ATO aren't out there to crucify business. They're out there to support people and trying to get out of where they're at. But yes, you've got to be genuine.
Yep.
And Olga, maybe if you could, can you explain, I suppose, the actual process from your perspective, and in terms of the nitty gritty? Okay, I've got a tax debt. I put my hand up and I've decided, or I've discussed with an accountant, that's the appropriate level I need to be. I can't go past that. I need some help here. I need to look at what my options are. I get in contact with yourself. What next?
What I might do is go through a case example, if that works for you, to explain how we actually help people. It might put it into a bit of perspective. So a perfect example, and I think where a lot of people might find themselves at the moment, is we had a removalist company that came to us, and they had about 400,000 of tax debt. So they'd spoken to their accountants. They'd also spoken to a liquidator about whether or not that was the only option. And they were referred to come and talk to us to see whether or not we could help them with that process. We have all of those discussions with them to make sure it is viable, to make sure the business wants to proceed. What we did first, and what we do first, is do this very detailed review of what their position is. As we were talking before, we go through their risk ratings. We talk about whether they've been in a position of compliance. So with your question about what's an acceptable percentage or level of tax debt, it also comes down to whether or not that business sits in the ATO's compliance bucket or non-compliance bucket. And those two buckets are really important moving forward on how the ATO will look at them. And the amount of debt isn't often affected about whether they're in either of those two buckets. This particular client was non-compliant. As I said, they had 400,000 of debt that had been going for about 8 years. What this review does is it tells us where they sit, whether there's anything like a garnishee order, garnish imminent, whether there's a director penalty notice that's about to be issued, and also what the amount of interest and penalties are that are sitting on the file. This particular client had 280,000 of historical accrued interest and penalties. So what we then did is obviously went through this report with the client, and then we did a very detailed application for both the remission of the interest and penalties that is based purely on those legal practice requirements that we were talking about before, if this client met those requirements. And we also went through with them what they can afford for an optimal and sustainable payment plan, which is really, really important. They have to be able to afford that payment plan that we put forward, otherwise the whole thing will fall apart.
Sorry, just to take that off for a second, there's a few people out there that seem to think that the ATO will waive more than interest and penalties.
No.
In your experience, is there any instances whereby the ATO are actually removing portions of the debt itself?
So my only experience of that is if you're about to die. And there are very, very finite applications that are specific hardship applications. An example would be very elderly, no assets, and a whole heap of other factors.
So individuals, not the actual business. So it's funny, there's a larger entity that myself and a colleague were looking at for some time, and they seem to have very similar situations to as you described. And I had cut you off, that had a portion of their debt that was, I suppose you would describe it as hardcore because it had kept accumulating and not being paid down. looking at your example of the transport company, in terms of from a broker's perspective, I look at that and think, okay, well, that transport company might have some receivables. They obviously would have a fleet, may or may not be encumbered, and maybe we've got a property owner involved there. How would you work with a broker in terms of a transaction like that too? How does that side of things work? Because I think there's a lot of people on the call, they'd obviously welcome, and a lot of people get scenarios that involve tax debt. So they'd like to have someone that works with them as a team. But I suppose their sort of fear is, okay, where do they sit in the process? So how do you guys work with brokers on that sort of situation?
So there's a couple of different situations. So there's certain situations depending how, if we're back in a normal world, how far along the collection process we're at, where people will need funding to pay a portion of the debt to the ATO quite quickly. And we work very closely with funders in relation to that. We often work also with brokers if a client wants to do a refi through a traditional lender, and the traditional lender won't finance them in any way, shape or form because of that tax debt. We'll work effectively as a hub, as a group, over it's a strategic approach where they will get the tax debt paid out by the funder so that they're then potentially able to borrow further down the track if they need to.
Cool.
They're probably the two main situations. But working with brokers and working with accountants is something we do all the time. We all sort of complement what everyone is doing to get the client through to the other side and manage it for the client. Clients are so stressed. This year's been really stressful as it is. But when they have this tax debt, we see it all the time, especially the big ones. They've had their head in the sand for 6, 12 months. It's just too hard. So if we can work with the brokers or work with the accountants and get it cleaned up and fixed, and eventually they're through to the other side and they can get on with running their business, that's what we want to do.
Provide some overlay, and thanks very much to Olga and Michael and Brian for sharing. There's obviously multiple components, and the one constant theme we all heard from our panel today was around, if whatever this position is on specific to tax debt, a client's got to be able to afford it. Now, the interesting part to that, of course, is that has been this culture of deferring, and that hasn't been limited to tax debt. It's been people's individual mortgages, it's been certainly equipment finance payments, and in their wisdom, one of the additional tools that the government provided, and it wasn't that well taken up, but they had a loan structure whereby banks and other institutions were providing a 3-year loan as a structure with 6 months of deferred payments, with obviously those payments then capitalised for the remaining 2.5 years. There is another structure that has not seen the light of day yet, which allows people to utilise that same pool of money towards more secured style loans. But in the short and medium term, I think that it's fair to say that small business is confused with a lot of the different loan options that are out there. And when it comes to tax debt, if anything, I've found since COVID that tax debt has become more of an issue, because there are a lot of lenders who weren't particularly looking at tax debt prior to now. They are more interested in the cash flow itself. Historical financials aren't what they used to be for a lender. So people will look through bank statements, and with bank statements, generally they will look and see some sort of a ATO payment. And conversely, if they don't see one in 6 to 12 months, then why not? So you're kind of damned if you do and you're damned if you don't. So from a lender's perspective, it's probably important for those brokers, accountants out there to know what some of those thresholds are. So as a rule, there's a whole stream of mainstream lenders that have a portion of tax debt, and certainly for more, an allowance, if you will. There's a magic number out there that many look at, which is 10%. However, if you've got a client that is within a mainstream bank, or maybe in a particular industry, good example, if you've got a pub as a client, a lot of the drinking holes, they have particular requirements And I noticed there was a few smiles from people looking forward to a drink later today as well. In terms of some industries, they have covenants with their lending with their banks, regardless of the amount. So it's important to know that tax debt, whilst it's not something that you might see if you're a home loan broker or you're an equipment finance broker, there was a very nice comment made yesterday about brokers needing to avoid being a sugar fix broker. And what I mean by that is that if we're doing more for clients, we're not an order taker. We're someone who has regular discussions with clients about what's important to them. And now working capital is more important than ever. So in terms of looking at tax debt and having those conversations, it's fairly important to make sure that we are looking at tax debt for clients and at least making sure we're having chats with those that are more aware of what's going on regarding the ATO, whether it be on a smaller scale or looking at professionals in this space. So I wanted to thank everyone for being part of today. I hope that everyone got something out of today in terms of the financing of tax debts. We have covered different elements of options there, but I mean, in terms of the underlying security, if anyone was looking for an additional session that may assist, there is a session this afternoon around looking at how debtor finance can assist with writing more asset finance. And the reason I bring that up is that when we're looking at solving more complex problems, a lot of the time we might be looking at multiple security. We also have a session backing onto this, which is around valuation of plant and equipment. So just a big thank you to Michael, Brian and Olga. Thank you very much. Really appreciate your time. And I hope that's demystified this for a lot of you. As I've said in most sessions, we've called these sessions Broker Illuminati, but you really shouldn't have to be part of a secret society to get the lowdown on what's important for clients, especially business clients. So thank you very much, everyone, for your time. I didn't notice any questions in the chat, but if you have any questions after today, please feel free to email me, and every one of our members on our panel would be more than happy to assist. And we'll obviously have some email contacts shared at the conclusion of today. So thank you very much, everyone, for your time. Really appreciate it, and look forward to seeing you at the other sessions. Thanks again. Cheers.
Thanks, Chris. Thanks, everyone.